Welcome back to Gold Off the Charts. First, I want to wish everyone watching a very happy new year. May 2026 bring you massive gains. I know the phrase financial freedom might feel a bit hollow right now. Over the 48-hour New Year's Eve countdown, while everyone was watching fireworks, the precious metals market was basically a total train wreck. The carnage was hard to watch. After silver crossed $80, it felt like it was pushed off the roof of the Empire State Building. It crashed over 16% in a single day, briefly dipping below $71. Gold, the market leader, wasn't spared either, posting its worst single-day drop since October. Prices are now testing the $4,300 level. Naturally, the sensational headlines are starting to fly. Amidst the panic, Wall Street's tech queen, Cathie Wood, dropped a prediction that sent chills down the spines of gold bulls. She claims gold could plummet by 63% over the next few years. That is a staggering forecast. If she's right, anyone buying gold now is looking at their portfolio being cut in half. That makes today's New Year's special absolutely vital. We aren't just reviewing this crash, we're standing at the start of 2026 to answer the ultimate question: how and when will this epic bull market end? Is the Queen's golden death theory just alarmist talk? Stick around until the end of the video, because this is about your asset allocation and survival strategy for 2026. First, let's put these 2 days of selling into perspective. If you watched my December 24th video, you saw this coming. This isn't a fundamental collapse. It's a perfect storm of a technical correction and year-end liquidity drain. Let's break down the causes. First, the CME hiked margin requirements. The exchange did this to cool off overheated speculation and force deleveraging. Many retail and institutional traders using high leverage were forced to liquidate because they couldn't cover their margins, a classic long squeeze. Second, year-end liquidity is paper thin. Most Wall Street big players are on vacation. When market depth is this low, a single large sell order can trigger a free fall because there are no buy orders to catch it. Third, profit-taking. Gold and silver had a massive run this year. Fund managers are locking in gains now to make their annual reports look better. My stance is clear. This is not a trend reversal. This is just a hard break on an overheated market. Honestly, the recent rally in gold and silver was getting too steep. Look at the charts. It was almost a 90-degree vertical move. In finance, no asset can move like that forever. An annualized return based on that slope is simply unsustainable. So this sharp pullback is technically healthy. It shakes out the weak hands and brings the market back to a more rational level. Even though the long-term bull case for gold is nearly flawless, such a steep rise will always lead to massive volatility. You need to be mentally prepared for these swings. However, a short-term dip doesn't mean the bull market is over. So, what would actually kill this bull run? I've discussed this for months with a mentor on Wall Street. Many analysts will tell you gold will die when central banks stop buying, or gold will fall if the Fed stops cutting rates. To be honest, those takes are so shallow they sound like AI-generated fluff. We have to look at the essence of gold. It's about hedging and wealth preservation. Why do people buy gold? Is it for the interest? Of course not. It's because we know other major assets like stocks, bonds, and real estate no longer offer good value. They are full of bubbles and risks. We buy gold as insurance to hedge those risks. So, when will the urge to buy gold fade? The logic is simple. When another major asset class becomes a significantly better deal. That other asset is primarily the U.S. stock market. Imagine if the S&P 500 crashed by 30% or 40% in the future. If stocks hit a golden bottom and offered obvious value, the gold bull market might pause. Why? Because at the bottom of a stock market crash, smart money realizes the expected returns on stocks far outweigh gold. They won't hesitate to dump gold and rotate into high-quality, undervalued growth stocks. Think of it this way. After a stock market crash, your gold insurance policy has already paid out. The disaster happened, it's over, and the policy has done its job. So, my conclusion, unless we see an epic stock market crash, that brings valuations to extreme lows, it's hard to find a reason for the gold rally to stop. Until then, gold remains the best safe haven in a chaotic world. Now, let's look at a more extreme view. In the last few days, the head of ARK Invest, the famous Cathie Wood, shared a shocking opinion. She believes gold could drop 45% to 67% over the next 4 to 5 years. Essentially, She expects gold to be cut in half or worse. Her logic has 3 points. First, gold is overvalued and has drifted too far from its fundamentals. Second, liquidity has peaked. She thinks central banks have finished printing money. Third, and most importantly, AI-driven deflation. Wood is all in on AI. She believes AI will skyrocket productivity and slash the cost of goods and services, leading to a long-term era of deflation. In a deflationary world, prices drop and the purchasing power of cash rises. In that scenario, gold, the ultimate inflation hedge, loses its purpose. She also hinted that capital will flee antique assets like gold and move into digital gold like Bitcoin or high-growth AI stocks. Does that sound plausible? AI definitely cuts costs, and Bitcoin has diverted some cash. However, I have a major problem with this logic. Cathie Wood is ignoring a fundamental reality: debt. The U.S. national debt is over $38 trillion and growing by $1 trillion every 100 days. AI deflation might make phones or cars cheaper, but can it fix a sovereign debt crisis? Will it stop the Fed from printing money? Actually, it's the opposite. If deflation hits and nominal GDP falls, the debt burden becomes even heavier because the debt is fixed but income shrinks. To prevent a default, the Fed would have to print money even more aggressively. This is the famous Fisher debt deflation theory. High debt plus deflation equals massive monetary easing. And monetary easing is the highest octane fuel for gold prices. Wood's prophecy is based on a tech utopia while ignoring our messy monetary reality. As long as fiat currency printing continues and the debt black hole expands, gold's status as the ultimate currency won't be replaced by AI. So, let's wrap this up. Faced with this recent crash and Cathie's doomsday prediction, what should investors do in 2026? My advice: stay sharp and block out the noise. This plunge is a technical correction, a natural breather after a massive run-up. It's like a marathon runner stopping for water. They aren't quitting the race, they're preparing for the next leg. Cathie's view is interesting, but I think the probability is extremely low. Because central banks, especially China and Russia, aren't buying gold just to fight inflation. They are buying it for de-dollarization and national security. That strategic need doesn't go away because of AI. The long-term bull trend for precious metals remains intact. Now is the time to test your conviction. If you believe the dollar is shaky and geopolitical risks are rising, then this deep correction is a gift to get on board before the next leg up. Of course, watch your risk. Even if the trend is bullish, 2026 will be a volatile year. Avoid high leverage and don't go all in at once. Size your positions so you can still sleep at night. Only those who survive the volatility get to enjoy the final feast. Finally, I wish you all the best in 2026. I hope that by the end of the year, when we look back at this video, we can all say, I didn't sell before the dawn, and I didn't get swept away by the storm. This is gold, off the charts. If you found this helpful, please like, subscribe, and hit the notification bell. I'll see you in the next video.